Hello, everyone. Thank you for joining me here on today's Inside Fashion webinar. I'm Jane Singer, and I am delighted to have you with us. A lot of people have asked us why we haven't been doing webinars recently. We are back on track to continue to do them. Today's webinar is brief. We're trying to keep it between 15 to 20 minutes because I know everyone is busy. So I appreciate your time. And without further ado, let's jump in. So today's agenda will be covering 5 critical signals that we're tracking in May. If you're familiar with Inside Fashion, in our Inside Sourcing section, we always have 4 to 5 signals that we're tracking for the current month, or let's say the current 6 weeks. So we have 5 that we're looking at in May. We're going to look at country impact of a lot of the things that are happening. And then at the same time, we're going to be going over what we see brands doing to try to navigate some of the pressures that are hitting both the supply side as well as the demand side. Now, 3 months ago, we thought the energy shock would simply be a bump in the road, so to speak. Turns out, well, it's 3 months and nothing seems to really have improved. There's signs that it's going to improve and then signs that it's not going to improve. So, realistically, we need to factor in energy as a very key part of the supply chain planning long term. We can't think that this is just going to go away anytime soon. It might, but again, it might be with us for a lot longer. So that's changed a lot of things because previously we were not really taking that as seriously. It was more consumer demand. It was more about, lead times and so forth. So 5 signals that we're watching: energy supply, naturally, tariffs, U.S. tariffs, that is, consumer demand, rising costs, and pricing power. So we got a lot of moving parts at the moment that everybody's trying to juggle and hopefully come out with none of the balls hitting the ground. First, let's take a look at energy. Energy is obviously the elephant in the room. We didn't see this coming. I mean, certainly when we were doing our forecasts for the first half of this year, or probably for most of this year, the big outlook was that energy prices were going to drop, that we basically had an oversupply of energy worldwide. Well, with the closure of the Strait of Hormuz, that's changed. Um, Oil prices seem to have settled in around $100 a barrel. Crude is, at the time of this webinar, it's about 95 roughly, but up and down a little bit for crude. And it pretty much seems to be settled in around that price point. Unless there's some kind of a dramatic shift in things, which doesn't look like it's coming, at least certainly not anytime soon. Probably oil prices are going to be around there. Obviously, the big thing that we're watching is really shortages. Right now, we know we have to deal with the cost situation, but will there be shortages that will affect factory production capacity? At the moment, not yet, but we again have to keep an eye on that because that could be really the bigger factor. Not that costs aren't a factor, but an actual inability to get the supply needed. And then also how that will impact logistics. Right now, they're still able to get enough fuel, but there are, at the consumer flight side of things, not the cargo, uh, cutbacks. And certainly, we don't know what could be coming in terms of not just higher prices, but like I said, actually less availability. So something that obviously is really weighing heavily on the industry at a time when so many other things are also weighing heavily. Now, if we look at tariffs, which before the energy crisis was the elephant in the room, sort of the elephant in the room, right, in 2025 were tariffs, which seems to gotten almost sidelined with all the attention on energy. But tariffs are very much in the picture. Yes, the U.S. Supreme Court did overturn those, the executive order for putting on those EEIP or whatever. Sorry, I can't remember the exact acronym at the top of my head, but they overturned that. And okay, they're putting through some refunds, but that doesn't mean that tariffs are off the table. I mean, they're on the table, trust me. I've spent a fair bit of time investigating this and speaking to people who are closer to the source. They are very, very much on the table. 301 investigations are going on, and most of the apparel supply chain the countries involved in the apparel supply chain are very much in the crosshairs. So we can't think that, oh, this isn't going to affect us. And, the Supreme Court turned down those other tariffs and we're getting refunds and all is well. No, actually, all could not be well. We don't know what the exact outcome is going to be. However, we do see that countries are making an effort to negotiate with the U.S. to see, is there something they can do to try to mitigate the potential damage. I mean, obviously, the key issues really are overcapacity and human rights. That's what they're looking for. And if they find violations or something that they feel is not right in either of those areas, then yes, we could be seeing 301 tariffs. Now, the thing is, human rights and overcapacity are quite subjective in many ways. So it'll be interesting to see how that plays out. The problem with 301 tariffs is they are much harder to get removed than the other tariffs. The current tariffs, I think, expire on end of July. Is it July 28th? I couldn't be sure of the exact date. However, those were for 150 days. Okay, after that they expire. They could be renewed, but not likely. However, 301 tariffs tend to be a lot stickier, as we've seen, historically. Once those tariffs are enacted, very difficult to get rid of them. So, yeah, no country wants to be burdened with that because that's a cost that, is definitely going to impact competitiveness. Um, Another issue that we're watching is consumer demand. Consumer demand has held up remarkably well. I mean, for a couple of years, economists have been predicting a downturn in consumer spending. And yet, consumer spending in the US and certainly in Europe has held up remarkably well, despite all kinds of other economic shocks from inflation, right, to higher energy prices from the Russia Ukraine situation, from everything going on in the world. Um, Overall, consumer spending has been not half bad. Definitely has defied expectations. However, this year again, there are very what you might call reasonable concerns as to how consumer spending will hold up, particularly if you know gasoline prices go way up and stay way up. Um, in a lot of countries, that's a big, big issue for consumers. If you rely on driving to work and every time you have to fill up your car, it's significantly higher than what you're used to, that hits hard. Now, it hits hard, obviously, for people who have lower incomes. Um, it hits their wallet, so to speak, in a very tangible way. However, the psychological impact, even for people who are actually not really going to be financially stressed by having to pay more for gasoline um, or for heating oil, if this thing drags on into the colder weather, there's a psychological aspect to it that makes people feel that they need to cut back. I mean, we saw that even in 2008 when the global financial crisis hit, and there were people um, who were very wealthy by anybody's calculation. And certainly, yes, of course, a dip in terms of your income is never a positive thing, but it wasn't enough to really change their lifestyle. And yet, we saw a lot of people who cut back on spending very radically, and almost surprised me to see that. We saw that cutback quite sharply because people panicked even when they probably didn't need to panic per se. But there was that sense that everything's going down and we better tighten our belts. So we're facing the psychological side of things as well as the actual, I don't have enough money to pay for discretionary things as well as essentials like the gasoline I need in order to drive myself to work. So we want to look at that. Certainly, in addition to consumer sentiment, we do see brands are continually reducing order size to the point where right now every order seems to be a micro order, much less. Certainly, everyone is trying to hedge and err on the side of caution. Nobody wants to be caught with overstock. People would rather at this point risk not having enough inventory and potentially losing a few sales than being stuck with excess inventory. That's how much people don't want any excess inventory. So yeah, we are seeing order sizes down in, the hundreds whereas people used to look for thousands. I mean, even 500 is considered a big order nowadays, surprisingly, but that's what it's come to at the moment, at least. And then, of course, we finally see the pressure that brands are facing. Who want to be able to move towards selling at full price, which is what everyone was discussing towards the end of 2025, to having to rely on promotions in order to at least drive sales, even though the impact on the bottom line is not great from that. So that brings us to cost inflation versus pricing power. Costs have gone up. We all know that. Materials costs have gone up a lot, right? 25% on petrol based, 27% cotton's up 27% as of May, since the beginning of the year. Wool is in a category of its own. It's not even impacted, right, by the energy shock, but wool has just been, on a fast track, with seemingly no ceiling. And then, the question is really, if the inputs are going up, not just your materials, but also logistics prices are inching up, will continue to inch up if oil remains under pressure. Um, how are we going to pass that off to consumers, right? I mean, can we raise prices enough in order to cover the costs? And that's not that easy, particularly as consumers feel a little more cash strapped or psychologically they want to cut back. People start to question, is this really worth it? So brands will have to really work extra hard to be able to raise prices. They'll have to, be going really hard on the value that you're getting for that additional price. And that's, it sounds easy to discuss, but it's not as easy when you actually have to execute on it. Now, if we look at logistics, that's an impact also. Now, the good news is although logistics, or what you might call freight rates and air cargo rates, are up, they certainly are still below last year. So that's a good thing. They haven't gone up as much as you would think. But again, if disruptions continue, we will continue to see pressure on price. I mean, if oil goes up or oil becomes, in short supply, you're going to see an impact on that even more. I mean, air cargo rates have settled down a bit since the initial big disruption in the Middle East. Um, the Gulf hub has been restored to, I think the last time I looked, it was about 70% capacity. So they are getting things back and getting things moving, but the situation does remain fragile. And it's something that we also have to look at, and we can't assume that this will not worsen. It could worsen. In terms of country movement, Vietnam and Cambodia continue to do very well on exports. Um, at the same time, if you look at Cambodia, which is showing incredibly strong growth, it's also strong growth, but off the fact that it does account for a smaller percent of total sourcing, certainly total sourcing out of Asia. Whereas Bangladesh has faced headwinds this year, but at the same time, Bangladesh does account for a tremendous amount of global volume, particularly into Europe, but also into the US. So as those countries have reduced the amount they import, Bangladesh will naturally take a bigger hit. Um, I think that Bangladesh will remain strong because Bangladesh has proven itself to be incredibly resilient. But we also see that Cambodia shows no sign of slowing down, and Vietnam, there is concern that it's maxed out and that wages are going to continue to increase and could actually increase quite sharply. Um, and then with India and China, at the moment, seemingly more stable, but China has the advantage, at least certainly for people who are importing into Europe, that it's got the supply chain that everybody wants, right? It's got the state of the art supply chain. And India has the advantage that it is a little bit less energy dependent. And there's also a lot of people who are expanding and diversifying. And so we do see more order that India is, in a sense, being lifted by more brands diversifying and heading into India. So that's helping India. But it's not an easy or certain time for any part of the sourcing map. Now, we also take a closer look at energy risk, and we did a matrix in our May issue of Inside Fashion in our Inside Sourcing section. And we just laid out which countries are most at risk. Who is most dependent upon imported oil and gas. Now, in some countries, the development of renewable or alternative energy has provided relief. It's not enough to offset shortages in energy imports, but it's certainly better than nothing, and it is helping. But again, prolonged blockage of the straits in of Hormuz is not going to be a good situation for anybody. So we have to keep that in mind. And again, energy risk is a real thing, at least for now. Um, we do take a country outlook in each issue of Inside Fashion. In May, we did a close up on Sri Lanka. A lot of brands have been asking us about Sri Lanka. Again, part of the diversification of sourcing. People have said, oh, I wonder, should we be re-looking at Sri Lanka? What are the opportunities in Sri Lanka? And Sri Lanka does offer a lot of solid opportunities for people who are looking for production that's high on compliance and can afford mid prices, right? So you're not going to be getting your cheapest prices, but there's been a lot of investment in sustainable manufacturing. And like I said, as compliance becomes a more critical issue, there are opportunities. Now, we dive into that a lot deeper in Inside Fashion, and we have a table that shows comparative data. So comparing wages, comparing energy costs, comparing infrastructure, and certainly all the other factors that are important to evaluate for sourcing. So you may wish to check that out. Now, when we talk to brands about how they are trying to sort of navigate the simultaneous supply and demand pressures, um, nobody really has the final formula, right? Nobody's figured it all out, but people are talking about how they're managing or what they're thinking about doing, and certainly. Yes, there's a lot more awareness, as we've been discussing, about diversifying energy risk and thinking about what countries we're very heavily in and what the energy situation looks like there. Um, but also building more flexibility into contracts, which is shorter commitments, right? Smaller orders. People want flexibility. They want speed, but they don't really do not want to get saddled with unsold inventory. Um, Also, people are looking at stress testing margins under different scenarios. Again, as you factor in the different costs that have gone up, um, how is that going to look? How are we going to manage with that? Or is the old model still valid? So people are looking at a lot of, recalculating how things stand. And then we also see more leaning into what we call hybrid sourcing models, which is bringing in agents, trusted agents, and trusted 3Ps for added expertise and flexibility because the asks are getting greater and greater. More countries, right? More services, traceability, data management, tracking of this and that. How can you do it all, right? It becomes really almost unachievable for almost any brand to do that. And so to be able to achieve these things as well as reduce risk, we are seeing more brands either bringing in third parties or at least thinking about it. And this is a topic that we're going to be discussing at FashCon coming up in June, June 12th, actually. And that is how brands are working with third parties, working with agents, working with 3Ps in order to be able to get a little more security around their supply chains. Technology is obviously a big thing. There was a time when technology and the apparel supply chain would never be used in the same sentence. Now, well, we may become a tech industry. But realistically, technology is something that everybody's seeing as very important in order to be able to manage a tremendously complex supply chain in a very volatile market. How do you manage it all just using the old ways? Well, probably not very well. So right now we see that interest in technology is very high, but stakeholders are evaluating solutions carefully. No one's really sure what's the thing that they need, right? There's so many things that are being presented as the next big thing, so to speak, as the answer to all your problems. But before people want to invest a tremendous amount of capex, disrupt what they're doing, onboarding, executing on things, it's not that easy. So therefore, people right now are trying to do, they're more in the research mode. I mean, there's a lack of clarity as to what we actually need and what, if we do invest in that, will it actually deliver? However, there's no doubt that technology is definitely a growing topic, um, a lot faster than people would have thought. Now, if you are interested in getting actionable sourcing intelligence, please join us at Inside Fashion. Um, each month, we give brands really a very concise, focused, and basically a working toolkit with information that is made to be fast to read, data packed, good for making decisions and analyzing risks. Um, Everything is designed for people who are busy, who want information, who need to be able to understand what's happening in the market and to be able to get that view without having to spend all day reading. So if that sounds like something that you could use in your business, please join us. Um, like I said, we have monthly information, but we also have bi-monthly or fortnightly, you might say, and even weekly updates on things that are more sensitive. For example, materials right now, we are putting out more updates because that's very volatile. So again, everything is really designed for people who are running global supply chains and who need to have that information. Well, thank you so much for joining me here today. It's been fantastic to have you with me, and I hope you've gotten some value out of this webinar. There's more coming. I think if you look below, you'll see a list of what's coming up, and more things will be added. Again, thank you so much for your time, and I wish you tremendous success.